All right, ladies and gentlemen, thanks for joining us here this evening. My name is Josh Asher, and I'm with Tesseract Asset Management. Tonight, we are going to be going over our 100-year market theory and give you guys kind of an idea of how to see the forest through the trees. One of the most difficult things that investors face is getting out of the everyday capitulation of the market and taking a look at it from a little bit more 30,000 foot view and really get an idea of where things are going. So we're going to break down over 100 years of market data. We're going to show you guys some longer term trends, some things that we see expecting coming forth in the next 4 to 6 years, and some things to watch out for. So any questions that are here, we'll hold it to the end. You can always give us a buzz at the office as well, 877-929-1510. So let's get right into it. You're going to be taking a look here. You'll see Oliver Wendell Holmes. And he says, when I want to understand what is happening today and try to decide what will happen tomorrow, I look back because a page of history is worth a volume of logic. Obviously, that quote resonates with us a lot, being that we've dissected over 100 years worth of market history to try to get an idea of the current economic cycles, cyclical, secular, and secondary trends that take place. And we're going to show you guys some of that today. So again, thanks for joining us, everybody. I know everybody's busy. Before we get started, I just want to remind everybody that sometimes it's best to have a plan. And if you don't have a plan, you can start to get a little bit confused at times. And so I want to show you guys some of these articles that I've picked up. These have resonated with me in my years of being in the market. And the first one here is probably the most famous one. I think everybody in here probably remembers this. It was put out by Newsweek, I believe, in 1979, and it's called The Death of Equities. And the article is about how inflation is literally destroying the stock market, and there's not going to be much left of it. The next one here came out in March of 2000, and it was a Money magazine article, and it was called How to Invest in the Hottest Market Ever. And the article literally talked about the safest ways to get into this market, the best ways to profit out of this market. And you can see from the little chart there kind of how that turned out. And then, of course, the one that really hits home to a lot of us is a Time article that came out in 2005 titled Home Sweet Home. We're going gaga over real estate prices. And, of course, we all know what the results of these things were. But looking back, I just want to give you guys some perspective on this. You can see the death of stocks came out in 1979. That was followed literally by the greatest secular bull market in history in the stock market. And as an FYI, this is going to be another part of our educational series that we're going to go into. But the majority of the asset allocation models, the majority of the frustration that most investors face today is due to the fact that the majority of the models built, and I'm not saying they're bad, I think they're great models for a bull market, were built in the period from 1982 to 2000. So as you can see, when the market actually goes literally almost straight up and then starts to go sideways, this is that frustration. But we'll get into that in another section. You can see the hottest market ever came out in March of 2000, and I think we all know what happened there, had a massive decline. And then, of course, the Home Sweet Home article came out in June 2005, and the peak of the real estate bubble was in 2006, which was followed by the greatest cyclical bear market since 1900. It was a sell-off of over 54.5%. So this isn't some sort of fear tactic or something like that, and I'm not preaching that we're going to have another massive recession. I'm just trying to give you guys an ulterior view at the markets and really to kind of think independently and take a look at where we're at from an independent standpoint and to try to create a roadmap. So I'm glad everybody's here. We're going to go through some of this stuff with you guys today. As I said, if there's any questions, we'll kind of hold them to the end. Today we're going to be talking about the 100-year market theory. First thing I want to mention, a lot of times when we give this presentation, people say, well, there's this and there's that. And you guys, this isn't the end-all to be-all. It's a foundation. It's more of a roadmap than anything else. And it kind of should hopefully, if it hits home with you, give you a basic understanding of what could happen based on history. We're not saying that that is going to happen. We're just saying that the probabilities lie in that it possibly could happen. So First off, before we actually get into the theory, I want to take 2 seconds. I promise I won't take too much time. I don't want to turn this into some crazy sales pitch, but I want you guys to know who we are. We're operating in a very niche industry. We are Tesseract Asset Management. We were founded on the idea of transparency with investors, education, communication, and innovation. If we can provide investors with complete transparency in good times and bad, education and communication to them constantly. We offer weekly research that goes out, monthly research, quarterly research, and obviously innovative products that are continually pushing the bounds of today's markets, utilizing the current channels and cycles that we're in, economic and technical, to provide the greatest amount of alpha while doing it on a risk-first standpoint. We can provide those investors with empowerment and trust. That's what our firm was founded on. We're located in downtown Orlando, in the plaza, and we're a private money management firm. We specialize in risk-controlled equity management. A lot of our clients are sophisticated individuals as well as some institutional clientele. And it's just, I want to take 2 seconds and talk about how we fit into people's portfolios. Most people think of a private money manager. They think of like a registered investment advisor or a wealth advisor, and those people are fantastic. They're very good at what they do. Really what we offer is a value-added service to an individual's portfolio, as long as they have, cash in the equity market. Maybe they have a mutual fund that is maybe underperforming, or they're in an IRA that they're not really happy with, or 401k, or maybe just an index position or something like that. We can take our funds, which are much more actively managed, and replace those inside of that portfolio, of course, and give you the added diversification of, decreasing risk in your portfolio. So that's who we are. We're founded. I want to share this quote with you guys. Benjamin Graham once said that it is only through the relentless management of risk based on arithmetic metrics in which investors can continually triumph over emotion and create success longevity, not by the management of returns on optimism. This quote is actually a paraphrase of 3 separate quotes by Benjamin Graham. And if you don't know who Benjamin Graham is, he is Warren Buffett's mentor. He's credited with being Warren Buffett's greatest mentor. He's passed away some time ago, but he really had a very unique way of looking at the world. And you can see just by reading this paraphrase quote of his, risk based on arithmetic metrics. Investors can triumph over emotion, not by the management of returns and optimism. And as you've seen from the previous magazine articles, all too often investors chase alpha. They chase returns. They chase that optimism. They're looking for the best case scenario. I'm not here to rain on anybody's parade. I just want to remind you that it may be wise to take an umbrella during the rainy season. That's all we want this to be, is to take a simple look at these markets and see how they work. We have a saying around here, and it says education breeds confidence, confidence breeds conviction, and conviction is the only metric by which we should make all decisions. All too often, investors, ourselves, everybody out there makes decisions they don't have the conviction with. If you don't have the conviction to stand by your decision, it is incredibly difficult to not act on emotion, fear, and greed, which are very, very powerful motivators in this market. I think we all know that by now. It's just a matter of actually conquering those things. I'm going to kind of come back to this saying. I'm going to show you some examples as we move forward, but I want to get on with the presentation in an effort of time. This is the 100-year market theory. And so you guys know it was the first market theory out there to combine technical analysis and fundamental valuations over an extended period of time to analyze the market. And we came out, originally published this theory in 2003. The chart you're looking at has data through 2002. And of course, you can see actually in this channel, when we came out with the theory in 2003 right up here, we weren't so popular. A lot of people out there did not want to believe that the market was going to be going in a sideways range here for the next 16 to 17 years. They were pretty frustrated. We were pretty much ostracized from Wall Street. And this isn't one of those kind of I told you so things. It's just a fact of the matter, and it shows it really kind of proves the previous quote that investors invest with returns on optimism. We've got to be realistic. If you take a look at this past data as we did today, you could see exactly why we believed what we believed. And of course, here's the most recent chart through 2011, and you can see we have the 03 downturn, and then of course the 08 recession here, and we're just kind of getting top side of this channel a little bit, which you'll see is very commonplace in these secular channels as we break this down. So that's kind of the theory in a nutshell. We're going to start from a very broad level and drill in as we go through the presentation. So the theory premises basically says excess market valuations due to extreme price movement upward over extended periods may take years to wane as earnings catch up with prices. And basically, what that means in a nutshell is that when you have these massive moves, like this move here from 1950 to 1966, you can see that the price to earnings ratio become very excessive along with the price of the stock. So it takes years of sideways consolidation on a secular basis while these earnings wane off over a very extended period of time, and only at that time can the market be poised for another secular bull market run. And I'm going to explain what the difference between secular, cyclical, you're going to hear those two words a lot today. I'll explain exactly what that is. So first off, before I get into that, I want to make sure that everybody understands there is some disclosures we have to make here. These are monthly bars. The secular model disclosures, this is on monthly bars. And also the price to earnings ratio that we have is on the S&P 500. It is a 10-year smooth moving average. There's two questions that people always ask when we talk about the price to earnings on the S&P and a 10-year smooth moving average. First of all, they say the S&P wasn't even around back in 1900, and we do agree. And they say, why do you use a 10-year smooth moving average? Well, I'll answer that question. Robert Shiller, who is a professor of economics at Yale University, wrote a paper in, I think it was 1997, and he basically detailed and did a massive study as to why the 10-year smooth moving average of price to earnings multiples is the best economic indicator for economic cycles. And after reading the paper, we obviously had a lot of conviction behind it, so we slapped it on top of the chart. And as you'll see as we go through this, you're going to see that it makes a lot of sense. It's good enough for him, it's good enough for us. The other thing is the S&P started in the mid-60s. We understand that. It wasn't around. Robert Shiller also took the exact same metrics by which stocks fit in the S&P 500 today and just backdated it back through 1900. So that's how we came up with that price to earnings. And we're going to be looking at monthly bars for the most part, folks. So let's talk about the three primary cycles that we have. We have, as I said, a secular cycle, which is a very long-term cycle. It's 5 to 20 years. We have cyclical cycles, which are 1 to 5 years. And then, of course, we have secondary cycles, which are weeks to a year. Now, most investors and most of the pundits on TV are usually going to be talking about the cyclical cycles here. They're usually going to be talking, when they refer to bull and bear markets, I can't say all the time, but the majority of the time they're going to be referring to cyclical bull and bear markets. We're going to refer to both of them. We're going to refer to secular a lot in this presentation, and we're going to refer to cyclical. We're not going to get so granular. I just don't have time to get into the secondary markets, but this would be more for active traders. And in those three separate cycles, we have three primary trends. This is pretty obvious. The market can either go up, down, or sideways. And I'm not going to get into the details as to what constitutes a bear market or bull market. We could debate over that for days. But in these secular and cyclical models, you have up, down, and sideways movement. And that's what we're going to talk about today. Very simple. We're going to try to keep it very simple as we move forward. The first thing that I want you guys to take notice as we start to zone in and kind of zoom in on this data is that the secular trends correlate to the PE trends. And what I mean by that is you can see we have a chewing off here that gave us a decrease in the PE. Then we have the bull market. That was a 5-year bull market that brought the PE up. The bear market, obviously the greatest bear market in the history of the stock market, the Great Depression, took it back down. Markets came back up, and it gets a little bit messy in here. And you can see we chewed it off until the 1950 markets hit, ran into another massive secular bull market. That ended in 1966, where we had to chew off the earnings for the next 16 years. And of course, the greatest bull market in the history of the stock market from 1982 to 2000. And you can see that we are currently in this sideways secular channel, chewing off the P to E, getting the price to earnings ratio reevaluated. We're moving forward in this channel, just making cyclical trends up and down. So that's one of the things that I want you to notice first and foremost. The other thing that I want to take a look at here, and you'll notice by the arrows that are popping up, is that the bull markets will end after the price to earnings ratio has breached the 22 mark and broken the secular trend. And you can see that by the arrows, and I'll go ahead and highlight a few things here for you guys. So you can see right here, the bull market went above 22, and you can see we went into a consolidation. Happened again right here, and of course we didn't go into a consolidation. We went into, again, the largest bear market in history. And of course, it breached 22 again here, and we went into a consolidation, breached it again here as well, went into a consolidation, and breached it again here as well, and we went into a consolidation. So, and you can see that sometimes it goes much higher than 22. Here in the 1937, the 1932 to 1937 bull market, the P to E ratio was up near towards 35, and if you take a look at it over here, in the dot-com bubble, it was up way past 35. So it doesn't mean that just because it breaches it, we're going to start to go sideways. You have to have a breach of 22, and you've got to see a break of your secular trend. So that's very broad market. This is all going to make a much more sense as we continue to kind of break this thing down. So let's talk about, now that we know when bull markets end, we can talk about when bull markets begin. And one of the numbers that you're going to notice, we've got 22 and we've got 10. Those are the two big numbers that we want to pay attention to here on the P to E ratio, because bull markets typically will end as soon as the trend is broke and they breach 22. On the flip side of that, they're typically going to begin on a secular basis when the price to earnings ratio has crossed below 10 and the sideways channel has been broken. And you can see it happen here in 1924. It happened here in the post-depression rally of 1932 to 1937, and again 1950 to 1966. After the PEs went below 10, you can see we have this big rally. And of course, the one that most of us are familiar with is the 1982 to the 2000 rally. After PE, the price to earnings ratio crossed below 10, we had the largest secular bull market in history. So you probably are asking yourself, so what's next? In 2008, the actual price to earnings ratio, the lowest it ever got with the credit crisis, was down to 13.32. So we haven't quite breached the 10 level yet, which is why it is our belief that we will see some further consolidation and some more whippy markets moving forward, and we're going to discuss that more as we get more granular with the theory. The other thing that I want you guys to understand and take a look at here is how the secular cycles kind of match up. And obviously there's some times here in the Great Depression where they don't match up exactly. Again, this isn't something that's finite to black and white, it's more of a roadmap. But you'll see here that the secular consolidation typically will relate to the previous bull market. So we had a 16-year bull market, we had a 15-year and 9-month secular consolidation. Here we had a 17-year, 3-month secular bull market. We're currently in the 12th year of the secular consolidation, and we expect another 4 to 5 years out of this consolidation before we pop topside and are able to sustain a secular bull market, which is a 5 to 20-year bull market. And obviously, as you can see here, the only instance with that not being the exact same is the bear market or the Great Depression, which is, again, the largest bear market in history. It is what we believe is the only secular bear market in history. And by the way, this move from 1929 to 1932 right here is over 90%. We had a 54% move here in 2008, and things were pretty bad. I could not imagine what it would be like if it fell another 40% on top of that. So a lot of people are saying, well, wait a minute. You've got these time frame correlations and these P/E correlations. How's come we didn't have a massive chewing off after this bull run? Well, the simple answer is if you want to go sideways, it's going to take much longer to chew this price-earnings ratio off in the stock market versus if you go straight down 90% like you did in the Great Depression. You can see that this thing just went down like it fell out of a window. And once it crossed below 10, broke this bear market trend and broke this trend here, you can see that we had the next bull market run. So now that we have an idea of the correlation between the price to earnings ratio and the time frames of these, we've got to start to find out how to map these out so we know what boundaries we need to play in, so we can get an idea of when we need to be more cautious in the market and when we can be a little bit more aggressive in the market. One of the things that you're going to notice by the purple arrows flying all over the screen is the first sell-off typically constitutes the floor of our secular channel. So as soon as we see that first sell-off, as you did, for example, right here in 2003, that's about where your floor is going to be. And you guys, these are areas, they're not exact points. And of course, that top of the previous trend is going to be your secular channel top side, your resistance, and here's your secular channel support. So now we kind of have a general idea of the channel that we're in, and we can start to dissect this a little bit more and look for smaller, more granular, or cyclical trends within the secular channel. Which brings me to my next point. I'm talking on a secular basis here. There's not a lot of secular traders out there, I would imagine, that invest for 5 to 20 year periods of time, and that's their goal. Most people are cyclical basis, and you're going to notice there are massive cyclical trends inside of these secular channels. 1910, 42% recession. 1937, 52% recession. 1973, 46.3, and of course the greatest cyclical recession since 1900 in 2008 of 54.5%. So guys, there's massive moves to be had inside of these secular channels. Let's get more granular. Let's break this down. Before we get into the charts, I just want to give you a couple things here. We're going to talk about halfway completed indicators. In other words, how do we know when we're halfway through the channel? And we're also going to talk about second half channel similarities. What are some things that we can look for as a roadmap once we've identified where the halfway point is? What can we expect in the next 4 to 6 years? So let's talk about that. Well, first and foremost, typically the deepest sell-off within the channel is the second cyclical bear market. That is going to be followed by the greatest cyclical bull market in that channel. And that cyclical bull market, the mass appeal of that bull market and the investors' need to not miss out is typically going to create a false breakout above the secular channel of anywhere from 5 to 18%. The second half channel similarities, there's much shorter cyclical cycles. So that means that the time frames that these trends are in place on a cyclical basis or 1 to 5 year basis, midterm basis, are going to be much shorter than they were in the first half of the channel. They're also going to be smaller cyclical downturns. We're not going to have the massive sell-offs that we've seen in the first half of the channel. That's the good news. Unfortunately, there's going to be a lot more channeling towards the end of the actual larger channel, which is just pure frustration. That's typically the point when most investors throw up their hands. They say, I've had enough of this. They have articles that come out like did in 1979 and say the stock market is dead, you better be careful, and then it goes on the greatest run it's had. Investors are sick and tired at this point. So let's break this down from a channel standpoint now. This is the first secular channel. You can see it's 1906 to 1924. And let's talk about what some of these similarities are. You can notice by the arrow that comes up, it's about the halfway point. We've got 9 years on each side of the channel. It's also identified by the deepest sell-off inside that channel is the second sell-off. And we have the greatest bull market run after the second sell-off, which is followed by exuberance and an exhaustion top, shorter cyclical cycles, which means that these trends, the time frame of these trends are much shorter, and of course the sell-offs aren't quite as deep, and towards the end you can see this blue area right here is a cyclical channel. Now I just want to point out on this chart it doesn't look like much. Guys, that's almost 2 years of absolute nothing. No movement at all. At least in this first half, you've got a 48% downturn, 89% upturn, 27% down, 29 up, 43 down, 107 up, 40% down. You've got some movement in here. You can actually play these in a long short run. There's different ways with the indexes now that you can get involved with this. This sideways movement is one of the most frustrating things that there are, and you're going to see it time and time again in these secular channels. So let's take a look at the second secular channel. Now this one is not quite as exact as the rest of the secular channels, and it is our belief that it isn't that exact because of the sheer watershed and panic that happened through the Great Depression, and the market was still working some of that stuff out. So there's a couple things you're going to notice. That the actual channel isn't exact. It's not very symmetrical. It's pretty dang close, but it's not exact. You got about 5 years in the beginning, 7 years in the latter half. However, it is accompanied by that the largest and the midpoint of that channel is still the second bear market inside the channel, and it's followed by the greatest cyclical bull market inside the channel. It has an exuberance top that comes up, or an exhaustion top that comes up towards it. The cyclical channels towards the end, the reason that this is wavy and not squares, they're not as short as the other channel characteristics, but they still are a little bit shorter. So it's not, again, it's not quite perfect, but it's pretty close. And you can see the downturn wasn't near as much in this one. And of course, there still was a cyclical channel towards the end that lasted 2.5 years and fluctuated 10 to 12% in those 2.5 years. So very frustrating times there from 1948 through 1950. So let's look at the third one, and when I get into this one, I want you guys to understand that you're going to see a lot of comparisons from the pundits on TV about this channel. It's really talked about a lot in reference to the current channel that we're in. So really kind of pay attention to this. This is 1966 to 1982. You can see the halfway point. We've got about 8 years on each side of the channel. You can see that the second the halfway point of that channel was the deepest sell-off inside the channel. And you can also see it was followed by the greatest bull market run inside that channel. We've got 80% here, 70, 35, and 40. So it was by far the largest bull market inside the channel. It was followed by an exuberance or an exhaustion top. And you have a shorter cycle period towards the second half, so things get much more choppy. It's that much more important to be able to turn on a dime and to be able to make a decision and have conviction behind your decision when you make it. And you can also see that the downturn isn't near as far. And of course, we've got a cyclical channel towards the end of the secular channel. Now, I also want to point this out because we get this question a ton, and it's, why don't you use the dividends instead of the price to earnings ratio? And while I'm in this channel, I just want to talk about it for a second. The reason that we don't use the dividends instead of the price to earnings ratio for the fundamental valuations is the fact that prior to this cyclical or this secular channel here from 1966 to 82, there wasn't a lot of stocks that issued dividends. The ones that did were mainly railroad or utility type stocks. So in 1966 and 1982, the majority of the stocks started issuing dividends because inflation was such a massive problem in the markets. There were CD rates that were getting 15, 16, 17, 18%. And stocks couldn't keep up with this, so they started issuing dividends. They started raising dividends to get people to buy the stock. So we don't believe that it is a better, I'm not going to say it's better or worse. We just believe, like Robert Shiller does, that the 10-year smooth price to earnings ratio is a much better, gives us a better idea of the economic cycles that the market goes through. So now here's the one that everybody's waiting for. It's the fourth secular channel. This is the one that we're currently in. You can see we've got the tech bubble that sold off here, of course the debt crisis here in 2008, and you can see we've popped topside of the secular channel a little bit, and we've actually even creeped up here a little bit more as of recent. So let's talk a little bit about kind of where we're at in this channel. You see the second sell-off is the deepest sell-off. It's followed by the greatest bull market. We've got an exhaustion or exuberance top coming up here. We know that the first half of the channel was about 8 years, and we can forecast based on history. We can, forecast is the wrong word, we can look at this as a roadmap and put the probabilities on our side that we've got about 8 years left. So we're looking at about 2016. And again, this isn't a finite thing. These are monthly bars, guys. This could be plus or minus a few months. So it's more of a roadmap, but you're looking at about 2016. So what can we expect moving forward? That's fantastic from where we're at. Well, we believe that we can expect shorter cyclical cycles, more choppy markets. We do not believe that the sell-offs are going to be quite as deep. And we do believe that we're going to see a cyclical channel towards the end of the secular channel. So that brings us to our next point. And we always get the question, what if? What if you're wrong? What if this market never looks back? It pops topside, we rip through 15,000, and we just take off. Well, if that happens, and first of all, I'm not opposed to that happening. I would love for that to happen. However, if it does, we're not going to miss that run. We're going to grab it on a confirmation, and we're going to get, just like everybody else, the majority of that run. And we will take our ability as portfolio managers and stock pickers and the understanding that we have on this, and we will continually attempt to outperform the market. But as I said earlier, it's more about conviction. It's more about knowing that you have the conviction. It's more about a roadmap. My question is, what if it doesn't? What's your plan if the market doesn't continue to take off? What are you going to do? You're going to throw your hands up in the air and just say, I can't figure this out, and hide your money in a mattress? And if you do, that's cool with me. What if the ECB defaults? What if oil goes above 110? We all know that's a very key number in the market. What if helicopter Ben runs out of gas and there's no more QE3 and there's no more artificially propping up this economy and where we're at? What if China's bubble bursts? Guys, this isn't like a fear factor kind of thing here. These are real issues that are weighing on every investor's minds right now. And I don't have the answer to what these issues are. But what I do know is that I have a plan if something happens. And not only do I have a plan, but I've kind of got a roadmap of what to expect. And it's back to that quote with Benjamin Graham. It's only through the relentless management of risk based on arithmetic metrics in which investors can continually triumph over emotion and create success longevity, not by the management returns on optimism. So I'm going to ask you again, what if? Are you going to manage your portfolio on the returns of optimism that this market will go up? Or are you going to manage it on an arithmetic metric basis that you can triumph over emotions with? And that's what it's all about. And a lot of people don't understand that, or they can't wrap their heads around it. And the perfect example that I can give is in 2007, we had egg on our face. In 2007, we did not grab the entire run of the market there towards the latter quarter. And I think the market was up, and I don't know for certain, but it was like 15, 16%, something like that. And we were up, maybe 4, 5, 6, 7%. We didn't grab the entire run. And our investors and other investors that we were looking at for our fund, they were like, you guys are crazy. You can't even keep up with the market. I can't do this. I'm running over here. This is good. I've got this guy. We're going to chase these returns. We're going to chase this alpha. And it was tough. And you want to talk about conviction. When you're getting told no and that you're wrong and everything happens, just like in 2003 when we came out with the theory, when everybody's telling you this isn't and you're crazy, you have to have that conviction. That's where it comes from. Education breeds confidence, confidence breeds conviction, and conviction is how you should make your decision, not by the management of returns and optimism. So to sum up the story, in 2007, we had egg on our face towards the latter half of it, and it didn't look good. And we were questioning, is this the right thing to do? Should we get in on this bus? And we didn't have conviction behind it. And since we didn't have conviction, we didn't do it. We did have conviction, however, when the market started to flutter towards the top. And we sidestepped 2008, and we minimized our investors' losses at that time to less than 1%. So if you take it and you look at it at a more grandiose scale, yeah, we missed out on 15% in 07. Let's just, for the sake of simplicity here. So we missed out on 15%. So they're ahead of us by 15%. However, on a 2-year scale, we only lost less than 1% in 08. And let's just say for the example's sake, we made 5%. So we're up 4% in 08. 2007, they made 15. 2008, they lost 40. They're still down over 20% in the market. It's about risk. And it's tough. It's tough to have the conviction. So it's nice to have other people out there that you can talk to and have a team, and it makes a lot of sense. And I just want to show this to you guys real quick. I'm not gonna sit here and give you a big sales pitch, but this is what we've done with the 100-year market theory. Kevin's been managing a long-only growth portfolio since 2001, and you can see the results that we've done, and we use the 100-year market theory as obviously our investment philosophy. Now, we've recently started a hedge fund. It's a long-short fund. That's about all I can really tell you about it. Because of the market metrics, we believe that the second half of this channel is going to get much more choppy. You're going to have the ability to go short. You better be extremely liquid. You better not be able to get tucked into these positions. So I'll leave you guys with one final slide. It's a great, I think he's one of the best musicians I've ever heard. It's Louis Armstrong, and he had a quote. He said, "Music is the space between the notes." And I say that because anybody can pick up a sheet of music, train it, and play it. Anybody can pick up a technical instrument, throw a moving average on a chart, and say when it goes above it, I'm going to buy it. When it goes below it, I'm going to sell it, vice versa. Anybody can look at PE valuation and say this is undervalued or overvalued. But it's the real talent, the real musicians, the legends of music are the ones that can have the space between the notes. And that's what this theory is all about. I hope it helps to give you guys a foundation. I really appreciate you taking the time to listen to us. And as part of our core values of education and communication, we're going to start to do much more of these educational videos moving forward. So visit our website, Invest TAM. They're absolutely free. We've got free research on there. You can sign up for it. It comes out weekly, which we do in-house, by the way. We're very proud of. So again, folks, thank you very much for your time. And I'm sure we'll be seeing you guys around. Have a great day.